For years, financial advisors have preached the 4% rule, telling you that if you sell 4% of your portfolio every year, you'll never run out of money. But what if I told you that's a terrible idea? The truth is, the 4% rule is broken. Markets crash, inflation eats away at your spending power, and if you're forced to sell stocks during a downturn, your entire retirement plan could crumble. What if you never had to sell a single share and your portfolio could pay you to retire instead? In this video, I'll show you why the 4% rule is outdated and why investing in dividend-paying assets like Realty Income, JEPI, or SCHD can give you a stress-free, cash-flowing retirement without ever having to touch your principal. By the end of this video, you'll know exactly how to build a portfolio that pays you to retire as early as you want. So, let's get into it. Welcome back everyone. Rico here. If you're new to the channel, I give financial, business, and leadership tips based on my 20 plus years at Fortune 100 companies, building my own businesses, and retiring early so I can focus on helping as many people as possible. Okay, let's start with the basics. What exactly is the 4% rule? This rule comes from something called the Trinity Study. It was created by financial advisor William Bengen back in 1994. And the idea is simple. You save up a retirement nest egg. The bigger the better, but do what you can. Then, in your first year of retirement, you withdraw 4% of your total portfolio. Each following year, you adjust that amount for inflation. But typically it stays around that 4%, assuming that your portfolio value also grows with inflation. According to the rule, your money should last at least 30 years. So here's an example. If you retired with $1 million, you would withdraw $40,000 in year one. If inflation is 2% the next year, you'd withdraw $40,800 and so on for the next 30 years. Sounds reasonable, right? But here's the problem. It was based on market data from 1926 to 1976. The world was definitely different and it's changed a lot since then, especially the stock market. So let's talk about why this 4% rule is outdated. This rule has some serious flaws for today's retirees. So first, market volatility. If your portfolio drops 30 to 40% in a recession, you're still forced to sell at a loss to maintain that 4% withdrawal rate. This is called sequence of returns risk, and it can devastate your retirement savings since you saved for a specific income amount that now has to change because the portfolio value went down. Second, longevity risk. People are living longer. The rule was designed to make your money last 30 years. But what if you live past 95 or even 100? Many of us will need our money to last 35 or even 40 years. Third, inflation. That $40,000 withdrawal today won't have the same buying power in 20 years. The rule assumes steady expenses throughout retirement, which isn't realistic with healthcare costs that tend to increase as we age. And let's not forget about those eggs. Oh, those eggs. Fourth, forced selling. You're not just withdrawing money, you're selling your assets, meaning your money has less time to compound. Also, you're lowering the value, so even with compounding, you're eating into it every single year. And finally, there's the psychological factor. Watching your portfolio balance constantly decrease can be stressful. Nobody wants to see their life savings dwindle year after year after year. So, what's the alternative? Instead of withdrawing 4% and hoping the market cooperates, why not invest in assets that pay you enough in distributions to cover your expenses? That way, you never have to sell anything. Well, unless you want to, you can of course do that. So, this is the dividend alternative. Now let's talk about how to actually live off your investments without selling a single share. This is one of my favorite strategies, for sure, and it's investing in high quality dividend-paying stocks and ETFs that generate consistent income. Instead of selling your investments, you collect dividends and distributions, letting your portfolio grow while still getting paid. And I'm going to show you 3 examples. And just as a quick reminder that none of this is financial advice. It never is. I'm not a financial advisor and I'm simply sharing my thoughts and perspective. Never just follow a guy on YouTube. Do your own research, please, and invest at your own risk. Now, let's get back to those examples. I'm only going to compare one stock at a time. For better diversification, you can use a mix of these stocks and ETFs. This is more just so you can see how it works. All right, example 1, we're going to use Realty Income, who coined themselves the monthly dividend company. Why? Because they pay dividends every single month. which is perfect for retirees who need regular income like myself. I can rely on these dividends and distributions every month. So Realty Income, ticker symbol O, has a 4.5% to 6% dividend yield depending on the value of the stock. This means that if you have $1 million invested, it would generate $45,000 to $60,000 per year, before taxes, of course. And keep in mind that Realty Income has increased its dividend for over 25 consecutive years. This definitely helps with inflation and added expenses over time. As a REIT, it's specifically designed to generate income. What I love about Realty Income is its predictability. They own over 13,000 commercial properties with long-term leases to reliable tenants. This creates incredibly stable cash flow that gets passed directly to you as a shareholder, of course, assuming you hold stock. And this is already better than the 4% rule. Keep in mind that Realty Income's stock value also grows over time, so you're not only protecting from inflation, but you collect a monthly paycheck as well. But what if you want even more income, you ask? Is that 4.5% to 6% not enough? Okay, let's go to example 2. JEPI, the JP Morgan Equity Premium Account ETF. So let's look at JEPI. Remember, this is Equity Premium Income ETF by JP Morgan. JEPQ is another one if you wanted to look into it. But let's talk about JEPI. JEPI currently has a whopping 8% dividend yield, which means higher income potential. This ETF is based on the S&P 500 and pays monthly, can provide you with even more consistent cash flow. JEPI uses covered calls to generate additional income premium that then gets distributed to stockholders each month. JEPI also provides some downside protection compared to the broader market like SPY or VOO. This is great for people who want higher yields and lower volatility compared to selling stocks every year. JEPI gives you exposure to quality blue chip stocks while generating significantly more income than you'd get from the 4% rule. Also keep in mind SPY, VOO, those are more focused on growth, so you may see more growth, but their dividend yield distributions only around 1%. I had to put that in there because I know I'm going to get comments saying like, well, what about growth in SPY and VOO? Just had to put that in there for you. Okay, so now let's move on to example number 3. If you want something that's between SPY, VOO, and JEPI. So let's talk about SCHD, Schwab US Dividend Equity ETF. This is a darling dividend ETF that a ton of people love, and for good reason. There's a high upside for growth, but you also have access to their 3.5% to 4% yield. Now, this isn't as big as O or JEPI, but keep in mind you're still at the 4% rate, but still not selling any stocks. But you also want to remember dividend growth. This will increase over time. So SCHD, it focuses on quality companies with strong histories of dividend growth. So you should see a great mix of growth and income. So if you want to make sure you're growing like SPY and VOO, but you have decent dividend income like JEPI, this is a good mix. So SCHD, this also has one of the lowest expense ratios than many similar ETFs. And it's pretty well diversified. It's comparable to the S&P 500. So what's special about SCHD? It's that your income stream likely grows faster than inflation over time. So while it might start with a slightly lower yield than our other examples, the growth potential is excellent. So instead of hoping the market plays nice with the 4% rule, you could build a portfolio that actually pays you to retire. Let's look at this. Let's see what it will actually look like over time. Okay, so comparing these strategies, let's look at how they'll play out over 20 years of retirement. And let's say you start with $1 million. Maybe that's attainable for some, maybe not, but just for round numbers, let's start with $1 million. And here's what would happen to your portfolio over 20 years. So looking at it here, with the 4% rule, where you're selling stocks, your annual income will start at, say, $40,000, but your portfolio value after 20 years could be anywhere from $0 to $400,000. There's definitely a real risk of depletion here, and your market risk is high. With Realty Income, your annual income starts at $45,000 to $50,000, and your portfolio value after 20 years could be over $2.5 million. Super low market risk. And then looking at JEPI, with your annual income at $70,000 to $90,000, so much more income, and your portfolio value after 20 years, it could be well over $3 million. Here there's moderate risk, but you're not selling any stocks. And then now looking at SCHD, your annual income starts at $35,000 to $40,000, but your portfolio value after 20 years could also be over $3.5 million. And your market risk, super low, plus no selling. No selling. No selling. So with the 4% rule, your portfolio is shrinking and might run out of money. But with dividend investing, your portfolio grows while paying you more money over time. Let me show you a few more visuals to make this even more crystal clear. Let's look at this chart, the portfolio value over 30 years. This first chart shows what happens to your portfolio value over 30 years. With the 4% rule, you can see your principal gradually declining as you sell shares each year. By year 30, your portfolio is significantly depleted. But look at our dividend approach. With O, your principal remains intact, possibly growing slowly over time. With SCHD, you see meaningful growth since you're never selling any shares. And with JEPI, your principal remains relatively stable with some slight growth. But again, you're not selling any shares. This next visual shows your annual income with each approach. With the 4% rule, your income increases predictably with inflation. With O, your income starts higher and grows as Realty Income raises its dividend. With SCHD, your income starts slower but grows more rapidly, eventually surpassing the 4% rule. And with JEPI, you begin with the highest income. Though growth may be more modest, you are going to have more income year over year. And this is where things get really interesting. This chart shows what happens during a 30% market correction. With the 4% rule, you're forced to sell more shares at depressed prices to maintain your income. With our dividend approach, your income remains largely unaffected or decreases only slightly during market downturns. This is why I say the 4% rule is broken, and living off dividends and distributions is the future. This is how you secure your retirement. Who knows what's going to go on with Social Security? If you don't have enough in your 401k, there's just too many questions out there. So why is this approach superior than the 4% rule? We already talked about a lot of this, but I want to go over it again. You never have to sell your assets in a down market. Your principal will remain intact. And granted, you will see ups and downs in capital value, but that's okay. You'll keep the same share amount by not selling. Also keep in mind that the stock market on average increases 7 to 10% every year. And over time, that even includes the down years. This means your income is more predictable and often grows over time. Plus, many dividend stocks and funds actually increase their payouts faster than inflation, meaning your purchasing power grows rather than shrinks. Also, there's a huge psychological benefit. Instead of watching your life savings dwindle, your portfolio can actually grow and pay you. Also, another quick reminder is that qualified dividends tend to be much better when it comes to tax treatment compared to withdrawals from traditional retirement accounts. There's different tax levels for qualified and unqualified distributions. And finally, you're building a legacy. Since you're not depleting your principal or selling shares, you'll likely have something to leave to your heirs if you want. Unfortunately, you can't take it with you, so there it is. Again, I'm not suggesting you put all your money in these three investments. A properly diversified dividend portfolio might include dividend-focused ETFs like SCHD, REITs like Realty Income, income-oriented ETFs like JEPI, quality dividend-paying individual stocks like Coca-Cola, Microsoft, and some bonds or bond ETFs for stability. The exact mix depends on your age, your risk tolerance, and the income that you need. Do your research, and I'd love if you comment down below on what you're doing to retire early, if that's in the cards for you, like me. So, which strategy would you rather follow? Selling off 4% of your portfolio every year hoping it lasts? Or investing in a portfolio that literally pays you to retire? I know which one I'm doing. Comment down below and guess which one you think it is. No bias. Also keep in mind that your stage of life also matters. If you're closer to retirement, dividend stocks and ETFs might be more enticing to check out. If you have all the time in the world, one, lucky you, I'm getting old, then investing in non-dividend paying high growth stocks might be your jam right now. Everyone's approach to investing is and should be different depending on your goals. So remember, it isn't just to survive retirement. You want to thrive. With a dividend approach, you can create lasting, growing income without the stress of watching your savings disappear. Let me know in the comments down below, do you follow the 4% rule or are you a dividend investor? I would love to hear your thoughts. Also, if you want to give me tips, what stocks are you following? All right, if you found this helpful, make sure you like, subscribe, turn on the notification bell because I've got more game-changing investing strategies coming soon. Also, check out some of the older videos. There's a lot of good stuff in those too. So thanks for watching. If it doesn't challenge you, it doesn't change you. Have an amazing week, everyone. Take care. I'll see you next time.